What if one of the world's most important tech companies just lost access to its second largest future market overnight? No announcement, no press conference, just a quiet order with massive consequences. China is pulling the plug on Nvidia's most advanced AI chips. And this isn't just about technology. This move sits at the intersection of finance, geopolitics, supply chains, and global power, and its ripple effects reach far beyond Nvidia's stock price. China cutting off purchases of Nvidia's advanced H200 chips is not a routine trade decision. It's a strategic signal, and it carries far more weight than most headlines suggest. Nvidia has become one of the most important companies in the global financial system, not just because of its stock performance, but because its chips sit at the center of the AI, data center and cloud computing economy. When Chinese authorities instruct domestic tech firms to halt purchases of Nvidia's most powerful AI accelerators, they are effectively reshaping the flow of capital, technology, and future growth expectations. For years, China has been one of Nvidia's most important long-term demand centers. Even as U.S. export controls tightened, the H200 was designed specifically to thread that needle, advanced enough to remain competitive, but adjusted to comply with U.S. rules. By targeting it anyway, China is sending a message that compliance is no longer the point. The issue is control. From a financial perspective, this matters because Nvidia's valuation reflects expectations of sustained global AI spending growth, not just in the US, but across Asia as well. Any disruption to that narrative forces markets to reprice risk. This isn't about lost quarterly revenue alone. It's about uncertainty, creeping into what investors believed was the most secure growth story in the market. At the same time, this move fits into a broader pattern of China, accelerating technological self-reliance while reducing exposure to U.S. choke points. Semiconductors are no longer treated as neutral inputs. They are treated as strategic assets. That shift turns Nvidia from a pure growth story into a geopolitical variable. And markets are notoriously bad at pricing geopolitics early. What makes this moment especially important is timing. Global markets are already sensitive to high interest rates, slowing growth and tightening liquidity. When a dominant tech name faces a sudden policy shock from the world's second-largest economy, it doesn't stay contained. It affects supply chains, capital allocation, and investor psychology. China isn't trying to hurt Nvidia out of spite. It's positioning for a future where access to foreign AI hardware is viewed as a vulnerability. That changes the balance of power in the tech ecosystem, and once that balance shifts, financial assumptions built over the last decade start to weaken. This is why the move matters far beyond one company. This decision also exposes a deeper vulnerability in how global investors have been thinking about the AI boom. For much of the last year, markets treated AI demand as borderless and inevitable, with companies like Nvidia positioned as neutral suppliers to the world's digital future. China's move challenges that assumption directly. By telling domestic firms to stop buying the H200, Beijing is signaling that access to cutting-edge U.S. technology is no longer something it wants to rely on, even if it means slower performance in the short term. That matters financially because China is not a marginal player. It represents one of the largest pools of data, compute demand, and long-term AI deployment potential in the world. When that demand is redirected away from U.S. suppliers, capital flows follow. Chinese firms will be pushed to accelerate domestic alternatives, even if those alternatives are currently less efficient. In the short run, this increases costs and reduces performance. In the long run, it reduces dependence. Markets often underestimate how powerful that incentive structure is. From a revenue standpoint, Nvidia has already been navigating restrictions, but investors largely assumed workarounds would continue. This move suggests those workarounds are closing. That introduces a new kind of risk, not regulatory uncertainty from Washington, but demand-side resistance from Beijing. For a stock priced on long-duration growth expectations, that distinction matters. Even if U.S. and allied markets continue to spend aggressively on AI infrastructure, the loss or degradation of Chinese demand changes the global growth curve. More importantly, it introduces fragmentation. Instead of one global AI hardware ecosystem, the world starts moving toward parallel systems. one centered on US technology, the other on Chinese substitutes. Fragmentation is inefficient, capital-intensive, and inflationary, which feeds back into markets through higher costs and lower margins. This is why China's decision isn't just a tech headline. It's a macro-financial signal. It tells investors that geopolitics is no longer a background risk to the AI trade. It's becoming a defining variable. This shift also has implications far beyond Nvidia, because it highlights how technology supply chains are becoming financial fault lines. AI hardware is not just a product, it is infrastructure. Data centers, cloud platforms, military applications, and advanced manufacturing all depend on access to high-performance chips. When China restricts purchases of US-designed AI accelerators, it forces a reallocation of capital inside its own system. Funds that might have gone toward foreign hardware are redirected into domestic chipmakers, state-backed research, and alternative architectures. In the short term, that transition is inefficient and costly. Performance gaps widen, timelines slip, and productivity suffers. But from a strategic perspective, those costs are acceptable if they reduce long-term vulnerability. This is where markets often misjudge the situation. Investors tend to focus on near-term earnings impact, while governments focus on long-term control. That difference in time horizon is critical. For US markets, the concern is not whether Nvidia can replace lost Chinese revenue immediately. It's whether the AI cycle remains as globally integrated as investors assume. If AI development splits into competing blocks, scale advantages erode, costs rise, margins compress, and capital expenditure requirements increase for everyone involved. That has knock-on effects for inflation, interest rates, and equity valuations more broadly. Technology-led disinflation, which many policymakers and investors hope will offset higher rates, becomes less reliable in a fragmented world. Instead of cheaper, faster innovation spreading globally, you get duplicated systems and parallel ecosystems. China's move accelerates that risk. It signals that efficiency is being subordinated to sovereignty. Once that trade-off is accepted, reversals are rare. This is why the decision matters beyond geopolitics or corporate earnings. It challenges a core assumption underpinning global markets, that advanced technology will always flow to where demand exists. Increasingly, that assumption no longer holds. Another layer to this story is how this decision feeds back into US financial markets and policy thinking. Nvidia is not just a stock. It has become a proxy for the broader AI-driven growth narrative that has supported equity markets during a period of high interest rates. When confidence in that narrative weakens, even slightly, it can ripple outward. Investors have been willing to tolerate tighter monetary conditions in part because they believe productivity gains from AI will eventually offset higher borrowing costs. China's move complicates that belief. If the global rollout of AI becomes slower, more expensive, and more fragmented, those productivity gains may arrive later and unevenly. That matters for valuations across the tech sector and beyond. It also matters for policymakers. A world where AI-driven efficiency gains are delayed makes the fight against inflation harder, not easier. Higher costs, duplicated supply chains, and reduced scale efficiencies all work against disinflation. This puts central banks in a more difficult position, especially at a time when rates are already high and debt burdens are heavy. From a market perspective, this introduces a subtle but important shift. Technology is no longer a pure solution to macro problems. It becomes another source of uncertainty. China's decision doesn't trigger an immediate crisis, but it adds friction to a system that was already operating with less margin for error. As that friction builds, volatility tends to follow. Investors may begin to reassess which growth stories are truly global and which are increasingly constrained by politics. That reassessment doesn't happen overnight, but once it starts, it rarely stays contained to a single stock or sector. The bigger overall message is that China's recent move significantly marks a transformative change, rather than merely a temporary disruption. Upon governments taking a strategic approach towards advanced chips, rather than simply treating them as commercial goods, the established rules of global technology markets undergo a permanent change. For investors, this essentially means that the AI story has become significantly more complex, and its outcomes are dependent on various factors. For instance, this changes the way AI market dynamics work. Growth still persists, but its dynamics are now influenced by policy synergies, geopolitical harmony, and domestic capability development, things which were not previously properly taken into account in the market's pricing. Moving forward for China, cutting off their purchases of Nvidia's H200 chip signifies a reduction in long-term dependency, even though the short-term adjustment presents a high cost. Similarly, the United States viewpoint reiterates how export controls and strategic competition are irrefutably generating countermeasures that alter genuine market demand. China taking this step against Nvidia highlights how powerful forces, including AI, semiconductors, and data, are deeply intertwined with national strategy. It does not mean the AI boom is winding down or ceasing. Instead, this marks the beginning of a new phase in which the focus shifts, less towards pure innovation and more towards fragmentation, duplication, as well as geographical distinctness. In this environment, valuation models that depend on uninterrupted global growth become increasingly difficult to maintain, correspondingly leading to heightened market risks and rising premiums for potential risks. In conclusion, this isn't about a singular chip or a single quarter's financial impact. Instead, it signifies the evolution of the world, from a unified efficiency to one driven by strategic separation and autonomy. And it's essential for understanding that, when this shift takes place, it is not easily reversed or negated. These changing global circumstances are why this particular moment is so significant, and why markets will continue to be affected by its outcomes, even long after the initial news fades away.